Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Thursday, August 13th, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
So imagine building a highly diversified equity portfolio, one perfectly designed to track the health of the broader economy.
Right, only to wake up and realize its biggest underlying risk is how much capital a single Chinese technology giant is currently spending on artificial intelligence servers.
Yeah, that is exactly what's happening beneath the surface of the indices today. And I mean, it's completely reshaping how we need to measure risk for you as an investor.
It really is.
Yeah.
So let's hit the daily outline and set the table with the 4 critical themes from today's proprietary updates.
Right. First up, we have a definitive confirmation of the disinflation narrative.
Yeah, via that July PPI miss.
Exactly. Wholesale prices are cooling much faster than anticipated. And that's driving this massive treasury rally and, frankly, just crushing expectations for a September Fed hike.
Which acts as the immediate catalyst for our second theme, right? U.S. equities are hitting all-time highs with really broad participation.
Yeah, but they're being actively pulled upward by this powerful options market dynamic. It's pinning the S&P 500 right at the 7,800 level.
Right. And then our third theme is this, a severe disruption in hard assets.
The divergence in commodities.
Yeah, both crude oil and gold are selling off as, geopolitical premiums fade and the market rotates out of those traditional inflation hedges.
Which brings us to our fourth theme, that hidden hazard we mentioned at the start, the emergence of a new AI risk factor.
Yeah, which is now officially driving more index variance than the traditional broad market factor. Moving to today's data, let's unpack that macro catalyst in the rates market.
Let's do it. The July Producer Price Index, or PPI.
It printed completely flat month over month, so 0.0% versus a consensus expectation of positive 0.2%.
And looking at the year-over-year figure, we saw a pretty sharp deceleration down to 4.7%.
Right. And for a non-professional investor trying to read these tea leaves, I mean, the PPI is the ultimate leading indicator, right?
Yeah, because it measures wholesale costs before they ever reach the consumer.
Exactly. When the pipeline of wholesale costs clears out, it just solidifies this broader disinflation narrative.
Precisely. And the reaction in the rates market was just immediate and highly structural.
It forced a massive repositioning across institutional desks, didn't it?
It did. We witnessed this broad, aggressive rally across the Treasury curve. But the belly of the curve is really what led the charge today.
Right. The 5-year yield dropped 6.5 basis points.
Which was the largest move across any tenor. And further out, the 10-year yield dropped to 4.645%.
So when we look at the pricing in the Fed funds futures market, the probability of a rate hike in September has essentially just plummeted.
Oh, totally. Just at the start of this month, that probability was sitting well over 70%.
But today it's pricing at roughly 33%.
Right. Plus, the peak cumulative pricing has been effectively removed from the terminal rate. It's now sitting just below 4.00%.
So the bond market is aggressively pulling forward the end of the current hiking cycle.
Yeah, signaling the ceiling for interest rates is rapidly caving in.
Understood. But applying our first principles rule here, there's a sort of a mechanical contradiction in today's Treasury action that requires some clarification for anyone managing a bond portfolio right now.
Okay, what are you looking at?
Well, we saw the 30-year Treasury auction price today at the highest yield for that specific tenor since 2001.
Right.
Yet despite that historically high auction yield, long-end yields broadly still fell on the day. The yield curve is steepening, and our desk notes attribute this to a rising term premium.
Yeah, the term premium is key here.
So just to make sure I'm grasping this for the listener, is essentially like locking in a mortgage, but from the perspective of the lender.
That's a great way to think about it.
Because if I lend you money for 5 years, I have a clear line of sight. I know your job security, I know the rough inflation expectations, and I'm confident you'll pay me back.
Right.
But if I lend you that same money for 30 years,
right,
the horizon is completely opaque.
Completely. Who knows what economic crises or inflation cycles will hit over 3 decades?
Exactly. So as the lender, I demand higher baseline compensation just for taking on that extended duration of risk. Is that what bond buyers are doing to the U.S. government right now?
Accurate. That is the exact mechanic driving the long end of the curve. Bond buyers are demanding higher compensation to lend to the government for 30 years compared to 5 years.
Because they're seeing the long-term fiscal risks.
Yeah, rating agencies project the general government deficit will sit at 7.4% of gross domestic product in 2026.
That's a lot of issuance to absorb.
It is. Heavy, long-term deficit issuance requires a premium. So the curve is steepening because the short end is dropping rapidly on immediate disinflation news like the PPI print, while the long end remains elevated due to that term premium.
Noted. But that term premium logic gets incredibly complicated when we look overseas. Pivoting to the international rates picture, the macro data presented a very different dynamic in the United Kingdom.
Yeah, the UK reported second quarter gross domestic product today, and it actually beat expectations.
Right, coming in at positive 0.4% quarter over quarter. But sterling still fell across the session.
The currency market just entirely discounted that positive growth data. Institutional flows focus squarely on the budget uncertainty ahead of the UK's upcoming fiscal announcements.
Paired with that hawkish commentary from the Bank of England, right?
Right. The backward-looking growth beat simply wasn't enough to overcome structural concerns about energy costs and future taxation.
And we're seeing a similarly heavy structural weight in Japan. The US dollar to Japanese yen pair retraced back to the 159.50 level today.
Which effectively proves that the Bank of Japan's record foreign exchange interventions had only a temporary impact.
Yes, structural carry pressures are just overpowering the central bank. I mean, when investors can borrow in yen at near zero rates and buy US dollars yielding over 4.5%.
That persistent yield differential will systematically crush any localized short-term currency interventions.
Pivoting to how these rate dynamics are directly fueling equity performance. The S&P 500 closed the session at an all-time high of 7,798.99.
But what stands out in today's proprietary updates is the underlying health of this move.
Yeah, the equal weight S&P 500 ticker symbol RSP actually outperformed the standard cap-weighted index today.
Which, for your portfolio, explicitly proves we're not just looking at a narrow mega-cap technology rally.
Right. We saw rate-sensitive defensive sectors, specifically real estate and consumer staples, leading the market right alongside technology.
Concur. The breadth is healthy, but the underlying mechanics of where the index closed require us to look at our daily data regarding the options market.
The 1700 pin.
Yeah, we tracked a massive gamma magnet that developed throughout the session, effectively pinning the S&P 500 right at the 7800 strike heading into Friday's weekly expiry.
Which creates a classic melt-up dynamic that overrides traditional fundamental trading. But wait, before we go further into the corporate movers, let's unpack that.
Sure.
You mentioned a gamma magnet. For a listener who doesn't spend their day staring at options order flow, what does that actually look like in practice?
Okay, so it comes down to how major dealers manage their risk. When dealers are long gamma, they are forced to dynamically hedge their books to remain market neutral.
Right.
As the broader index creeps closer to a strike price with massive open interest, in this case, the 7,800 level dealers are mechanically forced to buy the underlying index when the market dips and sell the index when it rises.
So they're buying the dips and selling the rips just to stay neutral.
Exactly. This constant high-volume hedging actively dampens volatility. It creates a literal gravitational pull that forces the index to stick to that specific strike price.
It starves the market of any natural downward price discovery.
Exactly.
Well, that mechanical pull certainly provided a powerful tailwind for individual corporate movers today. Looking at single stock actions, workday ticker WDAY surged 19% on the session.
Yeah, entirely driven by dealer desk rumors regarding a potential buyout by Silver Lake.
And elsewhere in tech, Applied Materials ticker AMAP reported an impressive top-line revenue beat.
But shares dropped roughly 4% in after-hours trading. That points to an immediate wave of institutional profit-taking following a very strong run-up into the print.
Meanwhile, Dell ticker DAL is decisively breaking out above a multi-month consolidation range today,
signaling renewed institutional momentum there.
But the most critical corporate data point came from Tencent, right? Their shares dropped 4.5% after reporting negative free cash flow for the quarter.
Yeah, and we have to be highly specific about the catalyst for that drop. It was a direct result of massive, aggressive capital expenditures strictly dedicated to building out AI infrastructure.
Right, their core operating business is generating cash, but the cost of the AI arms race, is just completely overwhelming their balance sheet.
Undeniably. And that 10-cent data point requires us to push back heavily on the broader tech euphoria sweeping the market right now.
Yeah, when we look beneath the surface of today's indices, our proprietary models are highlighting a severe structural shift in how risk is distributed.
The AI risk factor we mentioned earlier.
Exactly. It has now officially surpassed the traditional market factor as the dominant systematic risk driver in U.S. equities.
Which is huge. For decades, the primary driver of variance in a portfolio was its correlation to the broader economy, the market factor, or beta.
Right. If the economy grew, your diversified index fund grew.
But now, this customized AI factor spanning chip makers, power infrastructure, networking, it explains more of the variance in the Russell 1000 index than the general market does.
So the question we have to ask, using Tencent as the prime example, is whether the broader market is finally starting to penalize companies for excessive AI capital expenditures.
Affirmative. It is a vital distinction for risk management. Statistical factor models measure the hidden exposures within a portfolio.
So investors who believe they are safely diversified are actually sitting on unintended concentration risk.
Exactly. Your returns are now tied directly to the timeline and profitability of AI infrastructure. If CapEx continues to outpace free cash flow generation like with Tencent today, that factor will introduce severe volatility into conservative portfolios.
On that point, let's shift to the commodities and hard assets sector because risk repricing is fully evident there too, just for entirely different reasons.
Yeah, looking at the energy complex today.
West Texas Intermediate crude dropped 1.66% to close at $81.21 a barrel, and Brent crude fell 1.81% to $86.95.
The sell-off in crude is being dictated by dual drivers that are actively overpowering the physical tightness in the market.
First being those logistics reports, right?
Yeah, confirming at least 9 million barrels of Middle Eastern crude are scheduled to arrive at U.S. ports throughout August.
A direct result of the recent regional ceasefire agreements.
Right. It's a significant wave of supply normalization. And second, options market participants are systematically pricing out the geopolitical risk premium that had artificially elevated the curve.
So the fear of a major escalation in the Strait of Hormuz is fading.
Exactly, allowing the price to adjust downward and reflect baseline supply and demand fundamentals rather than fear.
But the more significant macro divergence is happening in the precious metals market. Gold dropped 1.31% today to settle at $4,350 an ounce.
Which, from a classical macro perspective, is highly counterintuitive.
Right. Normally, when we see lower real yields and a relatively flat U.S. dollar, both of which happen today, that provides the perfect backdrop to support higher gold prices.
Because gold yields nothing, so it becomes far more attractive to hold when treasury yields fall.
Yet gold sold off aggressively.
It breaks the classical correlation model until you look at the primary driver behind the falling yields.
Accurate. Gold is not selling off due to a sudden loss of intrinsic value. It's selling off precisely because the PPI data confirmed the disinflation narrative.
Yes. Over the last 2 years, investors piled into gold as their primary hedge against runaway inflation.
And with wholesale prices flatlining, the necessity of that hedge diminishes. Institutional players are just actively rotating out and locking in profits.
The broader commodity space firmly supports this too. Natural gas dropped over 2% today on a larger-than-expected storage build.
Pushing inventories well above their 5-year averages.
Right. And concurrent with that, industrial base metals struggled. Copper closed flat to down, weighed down heavily by lingering concerns over Chinese consumer demand.
So when we pull all these disparate data points together into a cohesive synthesis, the regime identification becomes pretty clear.
Concur. Today, we saw U.S. equities hit all-time highs with equal weight outperformance.
We saw the 5-year Treasury yield drop 6.5 basis points on cooling wholesale inflation.
And CDX high-yield credit spreads tightened to sub-300 basis points.
To put that in perspective for you, this specific cross-asset configuration is what we call the classic soft landing stool.
All three foundational legs are firmly in place.
All right, leg one. Inflation is coming down, validated by the PPI miss and gold selling off.
Leg two. Growth is holding up, evidenced by the S&P 500 at an all-time high with broad sector participation.
Proving it's not just an isolated tech bubble. And leg three. Credit is flowing freely without any signs of systemic distress.
When high-yield spreads tighten below 300 basis points, it indicates the market sees virtually zero default risk.
Yeah, companies with double B and triple C credit ratings currently have ample, highly affordable access to capital.
It's the optimal macroeconomic environment for risk assets. Corporate margins can expand without the headwind of rising debt servicing costs.
I hear that, but I have to challenge this perfect soft landing narrative for a second. This benign environment is not being distributed equally across the globe.
No, it's not. We're looking at a stark Asian bifurcation.
On one side, we saw the South Korean Kospi surge an impressive 3.56% today.
Heavily weighted towards semiconductor and hardware manufacturers.
Right, acting as a direct beneficiary of the global tech and AI tailwinds. But on the other side, China's CSI 300 index dropped 0.57%.
Yeah.
So if global growth is so robust, why is the world's second largest economy completely detached from this rally?
Because the weakness in the CSI 300 is entirely decoupled from the global technology cycle. It's rooted deeply in domestic consumer malaise.
Which was perfectly encapsulated today by the earnings report from JD.com, right?
Yeah, they posted their first quarterly revenue decline since their public listing in 2014.
Even with internal cost-cutting measures propping up net income, that top-line revenue contraction is a glaring structural indicator that the Chinese consumer is retreating.
Dealing with a property sector crisis and a lack of domestic stimulus, completely insulating them from the U.S. equity melt-up.
Affirmative. So the U.S. data cleanly validates the domestic soft landing thesis. But as disciplined market observers, we have to pivot to the inherent risk of this exact setup.
Look at the dashboard you're staring at right now.
The S&P 500 is sitting at absolute all-time highs. High-yield credit spreads are comfortably tight below 300 basis points.
And the VIX, the market's primary fear gauge, is heavily suppressed at just 14.63.
Historically, this specific configuration breeds extreme market complacency. It's a coiled spring.
It really is.
So the final provocative thought we need to leave you with today is this. Are investors fundamentally confusing a benign macroeconomic environment with a genuinely risk-free one?
Yeah, and with volatility priced this cheaply, is right now the exact moment you should be actively looking at inexpensive portfolio hedges before the next unpriced catalyst arrives.
Something to consider. To summarize today's core takeaways in rapid fashion, first, the disinflation narrative is fully confirmed by the flat July PPI print.
Aggressively pulling forward expectations for the end of the Fed's hiking cycle.
Second, U.S. equities are being pulled to all-time highs by a massive 7,800 options pin and an impressively broad sector participation.
Third, the newly identified AI risk factor is officially dominating systematic market variance, forcing a critical reevaluation of portfolio concentration.
And finally, the commodities complex is actively shedding its geopolitical and inflation premiums, driving steep sell-offs in both crude oil and gold. Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.